and welcome to yet another Crystal Ball. The guest on my show today is Bharat Rawal, Managing Director and Head of Macquarie Securities India, a face that you don't often see on television. Bharat, very good to see you in studio. How are you talking to your clients right now? Because there seems to be an air of profit-taking from most of your global clients post the budget. Is it to do with any specific disappointment or just profit-taking because some of the big events have played themselves out?
I think it's, as they say, buy on the rumor and sell on the news. We've seen clients that have piled into the market pre-election, pre-budget, and they've taken this opportunity to take some, book some profits. I don't think structurally the view on India has changed, but as you can imagine, long-only funds, they have NAVs, they need to book monthly profits. And I think this is a good opportunity for them. We've had a hope rally, we've had an election rally, and now we've got to wait for execution. And I think it's a good time for them to take some money off the table.
Any minor irritant or irritation caused by the GAR, or do you think that's not such a big issue as people are making it out to be, in the eyes of some of your global clients?
No, I don't think it is. I think structurally India remains a story that clients want to participate in. There will always be some hiccups along the way, but people, I think, are generally committed to the market. And I think news flow, execution, top-line growth, earnings growth, which is not just margin-driven, will keep people committed in the Indian securities markets.
Do you see most FIIs being patient and patiently waiting for some of the news flow to come through, the execution-related news flow, or do you see any dichotomy between the pace of execution and the pace of re-rating which is happening in stock prices?
I think the re-rating happened pretty quickly because the execution story hasn't really played out. In many ways, I think people are looking back at the last set of elections, or back to 2009, where the markets really made their big move pre-election as opposed to post. And I think people didn't want to miss out on that particular sort of period, which is why you saw a real rally pre-election. And then post-elections, of course, there was one because you had news, you had an outcome that people were hoping for. So I think it's a function of being involved in the market to the extent that you don't play catch-up, and at the same time waiting to see results. So you will probably see, like with any good market, it needs to consolidate a bit. It cannot go up in a straight line. So profit-taking, down days are not bad things.
So do you see this consolidation lasting for some more time? Because we've had an extraordinary first half of this year from an equity performance point of view. But do you see a few months of consolidation ahead, or just a short-lived one?
I would like to see a few months of consolidation ahead, which basically helps the market build on itself. It's a tough call in terms of where it's going to go, but the last few trading days, in my view, haven't been bad days. I mean, the market sold off a bit, it's come back, it's a stock pickers market, so we've seen clients do their top-down work, but now they're really looking at individual stocks. So I would think that the market continues to consolidate. I'd be a bit disappointed if I saw it really sell off, and at the same time I'm quite happy that it's not going up in a straight line.
And you see most of your clients approaching these dips with a sense of opportunity?
I think so, which is why you see names that sell off, usually they come back pretty quickly. They probably are not going back to their sort of year highs as yet, but you haven't seen quality names getting pummeled. You will see names where people have sort of got involved because they will re-rate with the rest of the sector. Those stocks invariably sell off more than the others, and it takes them a bit of, sometimes they might not come back, but those are the stocks that will remain laggards.
What tops the list of risks at this point? When you speak to most of your global clients, what do they worry about when they put in incremental money to work here?
In India, the India-centric risk as of now is monsoons, it's inflation, but geopolitics, India is not immune to it either. So we've got mostly tailwinds, but a few headwinds. So I think how the monsoons play out is going to be important. The co-inflation number, which we saw, I think, on Monday, was down, which was a positive. So the eye really is on interest rates, inflation, monsoons, which are key India indicators. But generally speaking, the U.S. environment, Fed easing, tapering or not, and geopolitical risks, they all sort of come into play. You cannot isolate India from the rest of the world.
Any of these powerful enough in your eyes to inject a 10% kind of correction in this market, a sub 7,000 kind of a Nifty level?
I think geopolitical risk might be the one key that might cause it. India specific, monsoons, could be a big factor. But generally speaking, I'd be surprised to see if you see that kind of a 10% correction in the market.
So what kind of target do you guys have at Macquarie 1 year out?
On the Nifty, we've got a 8,400 target. Rakesh, our analyst, our strategist and head of research in India, is looking at 8,400. He and the team feel that the market's currently trading on 15 times earnings, and it could move up to an historical average of about 17 times.
And from which quarter do you see this kind of acceleration in earnings happening? Because that's not been visible. I mean, earnings growth has still been in the high single digits. At what point do you see earnings giving you the hope that we are on our way back to getting to somewhere between 15 to 20% earnings growth again?
Not Q3. I think we're looking at Q4 and early next year, because I think you've got a new government in place, you've got a new budget, you've got new capex plans. They all sort of need time to sort of translate into the bottom line and into revenue growth. So I reckon, and as a house, we think it's going to be Q4 onwards. This earnings season's kicked off, but right now the earnings are growing mostly because of margin expansion. But as a top line growth coming into the market, we figure that it'll be Q4, Q1 next year.
Do you take any heart from the fact that the IIP number was a good one, or do you think it's a one-off? It's not such a pronounced industrial turnaround that we're staring at immediately.
I don't think it's a one-off, but we do take heart. I mean, it's one of those things where a new government, a new budget, all this is not going to play out instantly. So we've got to see, I think as investors, we have to be patient. And as people watching this market, one has to be cognizant of the fact that there'll be incremental positives that will all eventually add up, and I think that's what we've got to focus on.
Before I talk about the market leaders or the leaders of this particular rally, let me ask you about the sectors which dominated the market over the last couple of years, which is IT, pharma, and consumers. Do you think the sector rotation is complete, where most of your clients have switched around to the extent that they would want to, or do you see this churn from defensives to cyclicals continuing for the next few months?
From having spoken to our clients, I think the churn from defensive to cyclicals actually started happening with the smart money guys back in February and March of this year. I don't think it's done, but at the same time, I don't think people are going to. I think what happened was you saw selling in defensives to raise money to invest in cyclicals. But I don't think you'll see people bailing out of defensives just to be in cyclicals, because at the end of the day, you have to have a balanced portfolio. So I don't think the defensive names have enough growth in it to keep people excited, but at the same time, if you have a portfolio of stocks, you want to be protected.
So are you underweight as a house on some of these defensive sectors?
We are underweight. Off the top of my head, I don't know what our exact weightings on the defensive are, but if I look at our top 10 stocks in our portfolio, they're all cyclical names. But in our broader portfolio, we are underweight defensive and overweight cyclicals. But our top 10 picks are mostly, I would say they're all cyclical.
So of the cyclical clusters, which are your favorites between names like banking, infrastructure, auto? Which ones are the highest conviction for you?
Financials and industrials are the highest conviction, and on the financial side, it is the private banks. Our financials analyst Suresh, who I think has been on the show a couple of times, is quite clear that he is worried about public sector banks' capital. Private sector, we like Yes, Access, ICICI. Industrials, we like L&T. And on the commodity side, I think Coal India is our top pick.
Just one name in industrials, L&T. Does that mean that you want to stick to quality, at least for now, in this space?
I think quality is key in a market that is still sort of getting its legs, because you've got to see, like we talked about earlier, execution. So I think you've got to, the benefit of the doubt might be with the companies, but we've got to see them execute. We've got to see the numbers come through. L&T is high quality. Investors like the name. Its market cap is big. It's liquid. So people don't lose sleep when they invest in L&T and the stock's down.
On that note, we'll slip into a break. Back in a minute with Bharat Rawal, Managing Director of Macquarie Securities.